Students, this week we're going to be going over depreciation, amortization, and depletion. We're going to cover this in a week, and to be honest with you, you could probably do a whole course just on this topic. Uh, it gets to be pretty involved, and some of the rules are weird. A lot of tax rules are weird because they're just kind of arbitrary. That kind of goes doubly so for depreciation methods, amortization rules. They're just weird. We'll get into it. You'll see what I mean before too long. Okay, so we got depreciation, cost recovery, amortization, and depletion. As always, our learning objectives, explain the general concepts of tax depreciation and cost recovery, calculate amortization for intangible assets, and distinguish between amortizable and non-amortizable assets. Apply cost and percentage depletion methods and summarize the treatment for intangible drilling costs. Identify tax planning considerations for depreciation. Identify compliance and procedural considerations for depreciation. Okay, so why do we depreciate? Instead of immediately expensing the full cost of an asset, we will use over the long term, we spread the cost over the life of the asset. Matching concept of accounting matches expenses to the periods in which they will help generate revenue. If you purchase a machine that will last 10 years, it will produce revenue for 10 years. So expensing part each year makes sense. There's a YouTube video there. And book depreciation versus tax depreciation, it can be different. Especially kind of depending on the industry that you're in. But it's the matching principle, right? You try to match income with expenses, and it becomes a timing issue. Okay, so generally, you can only depreciate property used in trade or business or for production of income. No depreciation of personal use assets, that's kind of point one. No depreciation for assets with an indefinite life. Think land, that's always kind of the one that I go to. You can't depreciate it. Land does not have a useful life. It's going to be around longer than any of us. So it can't be depreciated because there's no timetable. Depreciation starts in the year the asset is placed in service. You can't buy something on December 31st of 2024 and not place it in service until February 15th and depreciate it for that year that you bought it. It's got to be placed in service. Tax depreciation can differ from book or financial depreciation. IRS generally uses makers. Book, there's so many different versions you can use for depreciation. Yeah. But typically tax, you're looking at makers, which we will go over here shortly. Allowable depreciation must be used to decrease assets basis, even if taxpayer does not recognize depreciation deduction. What that's saying is, if I buy a building, and I bought it for $100,000 and I place it in service, and I just elect not to depreciate that, my basis in that still goes down, regardless if I take that depreciation deduction or not. You can file a form 3115 to correct it, but unless you do that, once you sell it, your basis is reduced by the allowable depreciation that you could have taken. So always in your best interest to take depreciation. Bonus depreciation permits a taxpayer to depreciate 100% of an asset placed in the year placed in service. That's for 22. For 23, that falls to 80%, and then you get the 20% in 24. 100% bonus depreciation is allowed for qualified property placed in service from September 28th, 2017 through December 31st, 2022. That's part of the TCJA. And slide 3 of this, depreciation issues, tangible, physical substance, right? I can touch it, a building, a car, versus intangible, patents, copyrights, goodwill, loan costs. And then you've got real property, pretty much anything with dealing with real estate. Personal property, computers, equipment, vehicles, furniture that aren't real estate. Capitalization versus expense, and there's an issue with conversion of personal use to business use. In that building purchase for $100,000 that I had, let's say I hold on to that for 5 years. And after 5 years, that building now has a fair market value of 200,000. I can't just decide to say, you know what, I'm gonna actually start renting this out now and take depreciation on it at 200,000. It's going to be the lesser of your adjusted basis or the fair market value. Types of depreciation systems, here we've got post 12/31/86, pretty much the only one you're gonna see, right? You could work on a client that has been around since the 1930s. Pretty much every asset they've had since 86 is by this point going to be fully depreciated. So that's makers, again, that's modified accelerated cost recovery system, modified for real estate to 27.5 years and 39 years. 81 to 86, that's acres. Length of recovery from 3 to 19 years, shorter recovery for real estate and acres. That was originally enacted by Congress to kind of spur the economy. That's what this line added to spur cash flow investment. Prior to 81, it was the useful life methods. How long is this thing going to be useful for? That's kind of your depreciation system. It has gotten far more complicated since 1981. Here we've got makers, the one you're going to see the most often if you're in tax. Use for property placed in service after 12/31/86 does not consider salvage value. So salvage value means nothing to us. It could for GAAP and book purposes, but for tax purposes, there's not a salvage value. Uses specific asset classes to determine depreciable life, and lives range from 3 years to 39 years. Uses conventions. There is mid-year, mid-quarter, and mid-month. Assumptions when assets are placed in service or disposed of. So here we've got the half-year convention, assumes all acquisitions and dispositions take place at the midpoint of the tax. You purchase something on January 10th, cool. It's like you bought it on July 1st, and that's your depreciation. You take half the depreciation for that year. And mid-quarter would assume that it was purchased on February 15th. Quarter one is January 1st to March 31st, midpoint of that, February 15th. If an asset is disposed of before being fully depreciated, the full year's depreciation for the tables will have to be multiplied by 50%, calculating the deduction, and that goes back to the half. The different conventions, which I mentioned previously, you've got half year, they call it mid-year. Mid-quarter convention applies only to special circumstances, 40% of property placed in the service in the last quarter. So let's say that I had $100,000 of depreciable equipment that I purchased for quarters 1, 2, and 3. And I'm looking at quarter 4, and I'm thinking, man, I've got a huge amount of cash, and I have a huge amount of net income, and I want to lower that. So I'm going to spend $100,000 on equipment and take that half-year convention. This is going to say you can't do that because that's greater than 40% of everything that you would put in. And then finally, we've got real property. That's the mid-month convention. Similar concept, but for real property, it's different. It's mid-month. Steps in calculating depreciation for personal property. You determine the costs. The salvage value, again, 0. Select the method. Default is going to be the 200% double declining balance, but you can also do 150% declining balance or straight line. Determine the recovery period. The book has an entire schedule of this. You could also Google it. What's the useful life of such and such asset? When you select your convention, default's going to be half year. That's the one I see most often. Mid-quarter could apply, going back to you try to load up on assets placed in quarter 4 to lower your net income. That's going to apply. And then you multiply the rate times the cost. It's pretty easy. The book has the table associated with the different rates for makers. I'm not going to go over all this, but we'll go through one instance. Also, I would print this slide out. So let's say that, we purchase a $40,000 vehicle, and it's for a business. So, okay, here we start. Is the asset used in trade or business or for production of income? It is. Is the asset tangible or intangible? It's a vehicle, so it's tangible. So we're going up here. Has a taxpayer elected depreciation method not expressed in years? We have not, because we're saying that it's going to be 5 years. That's what vehicles are. Is the property real or personal? And it is personal, so it's aggregate of personal property greater than 40%. No, we're going half here. I'm going to stop it there because section 179 warrants its own video. So, all right, we'll be back here real soon.